Today, we're going to cover received cash from sales. We're going to look at sold services on account, paid cash for a bill or for an expense, and then received cash on account. And then the last one is owner withdrew equity in the form of cash. So we're going to cover all of these transactions today. Hello, accounting. Today might see a little bit of a different view. Just want to try something different here as we go through a couple more transactions today. And if you look at the learning objectives, it says how transactions change owner's equity. So our owner's equity in an accounting equation. So that's a really big hint that all of these transactions, except one of them today, are going to affect our owner's equity. And we get into something that probably is pretty familiar. It's just talking about revenue. So when we make a sale, because that's what a business is trying to do, right? And then when we also have expenses and how that affects things. So I know that there's a lot of transactions that we're going over right now, but hopefully these are something that is kind of easily identifiable due to you kind of knowing what a sale is already, hopefully, and a revenue. So let's move forward here and jump into some of these transactions right away. And these little pictures are really great to take a look at to see how each account is affected. And on this page, they have two different transactions that are taking place that are affecting owner's equity. Let's look at the first one. The first one is just receiving cash from sales. Now, this is the entire objective of running a business, is to make some money, okay? And what this looks like, excuse me, gonna have hiccups, right? So I'm not even gonna edit that out. We're keeping it in. So as we look at this, what we want to start looking at is when we actually make a sale. And what we're going to call that is revenue. Okay. So anytime that we have a sale, it's going to be called revenue. And the big thing is, how does revenue actually affect our accounting equation? And that's what we want to take a look at today. So when you make a sale, a normal sale, like in our minds when we think of things, we usually receive cash. Now, it doesn't matter if you use your debit card or cash. Whenever a business makes a sale, they usually count it. If they're receiving that money at that time, they're going to count it as cash. Okay. So even looking at the phrase received cash from sales, there's two accounts that we're going to look at right away. Or two words in there that we're going to look at. The first one is we received cash. So what's the first thing that's going to be affected? And this is just for received cash from sales. So let's look at that. Received cash from sale. So what's going to be the first thing that's affected? Well, it's definitely going to be cash, right? And what happens to cash if we received it? It's definitely going to go up. So we know cash is an asset. We know that cash is going to go up. That's part of the business that we want to succeed, right? And we know that this is a revenue, and revenues are going to affect our owner's equity. So what's that account that's usually affected? It's our owner's capital account. So the other account that we have is owner's capital. And remember, this owner's capital account is showing us the stake in the business that the owner has. So it's the claim to those assets after all the liabilities are paid off. So wouldn't it make sense that if a company's being more successful, they're making more sales, that the owner's capital would actually go up, right? Because if the business is really successful, it's not like the owner just never gets any more like claim to those assets, and it's just the business. The owner now has a bigger kind of piece of the pie, right? With his capital account. So that's the first thing that we're going to look at. This revenue, when we receive cash from a sale, is going to affect cash and it's going to affect owner's capital. When we look at that, cash is on the left-hand side, owner's capital is on the right-hand side. Our accounting equation is going to be balanced. The next one that we're going to look at, though, is sold services on account. Let's just move to another page here. Okay, so let's write this down. Sold services on account. Oh, helps if you can spell. Okay, sold services on account. Now, the interesting thing about this is if we kind of scroll up and look, it's also a revenue, okay? So let's just jump into this real quick. Some of the things that we did, we sold something, okay? Anytime that we sell something, it's going to be considered a revenue. So this is actually in the revenue family, all right? So let's just put that up there. And because it's a revenue, we know it will actually affect our owner's capital. But we'll get to that in just a second. When we sell services on account, we hear that on account. And previously before this, when we think of on account, we immediately think of a liability, right? That's what we've looked at because we've bought supplies on account. Well, here, what's occurring is we are actually selling something to somebody else on account. So we're providing a service and they're saying, yes, we want to buy that service, but we will pay you back later. So now what's happening is we're creating a whole new account called accounts receivable. So let's write that down, okay? Accounts receivable. E before I. Oh my goodness, good thing this isn't an English class, right? Alrighty. So what happens there is we create an accounts receivable. And what we're going to do now is this accounts receivable is going to be tied to the company that owes us money. So this was to, if you look at the book here, it was to accounts receivable, and we'll say Main Street. Okay, because I think that's what it's called, Main Street Services. So accounts receivable is very interesting because it means that somebody owes us money. Now, where would this go? An asset is something that we own. Okay, an accounts receivable is technically something that we believe somebody is going to pay us. So this accounts receivable right here is going to be considered an asset. Okay, so anytime that we have an accounts receivable, it is an asset. When we scroll up in the book, you can kind of see that. That is going to fall underneath assets. So just like cash, just like supplies, prepaid insurance, all things that we own, when we have an accounts receivable and somebody owes us money, we are very trusting. We think they are going to pay us 100%. So if this accounts receivable is an account that's tracking how much somebody else owes us, would it go up or down here? Well, it's going to go up, right? So for this, it's going to go up. Why? Because we want to show that Main Street owes us more money. That increases. So this is considered a sale on account, sold services on account. The question is, what's the other account that's affected? Well, the other account is going to be our owner's capital. Okay, so let's put that in there. Owner's capital is also going to increase. So now we have an increase on the asset side, and we also have an increase on the owner's equity, owner's capital side. So the accounting equation is in balance. The weird thing about selling services on account is that we just assume that we're going to get that money no matter what. Okay, and it's a very important distinction. This is still considered a revenue. All right. So if we look up a little bit to the very top, you can see here that the second part is part of this transaction where it pretty much says sold services on account, accounts receivable goes up 500, Michael Delgado's capital goes up 500, and it is a revenue. So there we go. That's our first two transactions. They're both revenues. If we move on, now we get into expenses. And expenses is just kind of like a little bit more common sense, right? Because a lot of times we're paying cash for expenses. So here it says paid cash for a communication bill for cell phone and internet service. Sometimes it's going to say paid cash for like a utility bill or anything else. Anytime that we need to pay for something to run our business, and we pay for it right away. So the cost of those goods or services is considered an expense, and an expense is still going to affect our owner's equity. Okay, remember this chapter is all about how owner's equity is affected. So let's take a look at expenses. Most of the time, we're going to be paying cash for expenses as well. So let's look at that first transaction. Paid cash for a communication bill. Okay, I'm just going to put that on there. Paid cash for, I'll just put bill. We don't have to put all that other stuff there. Looking at this, we do the same thing with any transaction. We say, what are the parts of this transaction that are going to change? Well, we paid cash, right? So we know that cash is going to be affected. So cash, being the asset it is that we use, is going to go down. What happens over here? Well, if we have to pay for something, just like when the business makes more money and owner's capital goes up, when we have to spend money to make money with an expense, our owner's capital will go down. So now for this, we have owner's capital, and this will go down. So we have an asset that goes down, and we have owner's capital that goes down. And we are going to make sure that we record this as an expense. So they go through two different transactions here, and is paid cash for an equipment rental for $400 and paid cash for a bill. The same thing happens on both of them. Okay, it doesn't matter. It's an expense. And anytime that we have an expense, and we paid cash for it, our cash will be affected, and capital, which ends up being our owner's equity here. Okay, there we go. That's an expense transaction. They're all pretty much the same. The only thing that messes with kids is what the expense is for, because sometimes we just don't recognize some of those terms. So really though, not too bad. And then here's some other cash transactions. And this gets, I'd say, I don't want to say really difficult or anything, but once again, we're just adding more transactions here. So the first one is received cash on account. Let's write that here. Received cash on account. I'm pretty sure I spelled received wrong last time. Okay, so breaking this down, I received cash, so you know cash is going to go up, and then on account, and you're receiving cash on account. Now remember before, we paid cash on account because it was a liability that we owed. Now, somebody that owes us money is actually paying us. So what's that going to be? This on account, so we have cash, and then on account right here is going to be our account receivable. So those are our two accounts. I wish I went to I wish I went to circled that one so it'd stand out a little bit more. But accounts receivable and cash are going to be our two accounts. So when we look at this, the two accounts that are affected are cash and accounts receivable. Something very, very important to note here. Okay, you might think that this is considered a revenue. Okay, some people might look at this and go, oh yeah, this must be a revenue. All right, and this is going to affect our owner's equity. Now, this is probably one of the hardest things to get in this unit. Okay, people think it's a revenue and they think it's going to affect our owner's equity, but it's not. Okay, it is not a revenue, and it is not going to affect our owner's equity. Now, why? Well, the reason why is because it already affected our owner's equity previously. Do you guys remember when we sold a service on account and we recorded it under Michael Delgado's capital when we already recorded it there? Well, if we recorded it again, we would literally be writing in our owner's capital 2 times, right? We'd be increasing our owner's capital twice, and we've already recorded it. So it's a very important distinction to know that when we receive cash on account, this transaction is a secondary transaction, right? It's the second time that we're dealing with this transaction, because previously before this, we sold services on account and we recorded as a revenue under owner's equity. Now we're just getting the money that we're owed. Okay, so the 2 accounts that are affected, once again, cash and accounts receivable. And when we look at this, what's going to happen with cash? Well, we received it, so it goes up. And accounts receivable now is actually going to go down because this is the record, this is the account of how much somebody owes us. So this was Main Street, remember? Now Main Street owes us less money. So here we go. These are both assets, remember. So if they're both assets, is their accounting equation in balance? We have a plus and a minus. They make it so the accounting equation is still in balance because they will kind of cross each other out, right? So there we go. That's received cash on account. Very similar to when we pay cash on account, except now it's somebody else paying us, which is great, right? And now we have one more transaction. And this one is a little different, okay? And it's paid cash to owner for personal use, okay? Paid cash to owner for personal use. Just looking at the words, okay? Looking at the words that we have. Paid cash. What's happening first and what's affected? Well, cash is going to go down, right? We can see that right away because you guys have done a couple of these now and you can see the kind of pattern. This transaction here is considered a withdrawal, okay? So this right here is considered a withdrawal. Right? So have you ever gone to the bank and taken money out or gone to an ATM? It's like the same thing. It's a withdrawal. The thing is this is withdrawing money for the owner. So the owner is taking money out of his own business. Now, is that fair? Yeah, absolutely. It's his business. They've made investments into the business, right? We've received cash from an owner as an investment. Now, let's say the business is doing really well and the owner wants to pay themselves. Well, we need to record the owner paying themselves. So what's going to happen here? If you kind of look up top, we can see that the cash is going to be affected. But then what's the other account? Well, it's going to be the owner's capital, okay? Because when the owner takes out this cash from the business, their stake to the assets actually goes down, right? This owner's personal bank account went up, okay? That went up. But remember the business entity concept? We don't actually mix the owner's bank account with the business. It all has to be recorded separately. So now, because we paid cash to the owner for personal use, cash goes down, and then the stake in the business of the owner actually goes down as well. Is the accounting equation in balance? Yes, it is. And this is a withdrawal. So you're going to need to label a lot of these transactions a revenue, an expense, or a withdrawal. Now, remember, there was one transaction when we received cash on account, and that was none of them. Okay, that's not a revenue, an expense, or a withdrawal. That one is that's none of those other ones. Okay. There's one thing that I just want to cover really quickly, and that would be the last little gap principle that's covered in this chapter. And that's called realization of revenue. And it is going to be under sold services on account. Okay, so I'm just going to visit that real quick. Realization of revenue is pretty much means that when you sell something, even if you didn't receive the money yet, you must record it. All right. So this is one of those gap principles, making sure that everybody's doing things the same way. The reason being is because, let's say, it gets a little bit complicated. So what you really just need to know is when you make a sale, even if you haven't received the cash yet, but it's agreed upon, you're going to record it as a revenue or as a sale. If not, some people would wait to write it down until they receive that cash, and they can kind of cook their books, they call it. All right. So maybe you tell somebody, hey, don't pay me. I'm going to do this service for you, but don't pay me till January 1st because for tax reasons, I want you to pay me then. So it's just one of those special rules called realization of revenue. All right. So that right there is our transactions for the day. If hopefully writing it out, if you're not here, might help a little bit. You see they kind of do a summary of those transactions, but this is 1-3 for the most part with those transactions. And now we're going to work on the work together and on your own. So I will see you in a second. All right, so let's take a look at the problems for today. It's 1-3 for the terms review, working papers, and application problem. Terms review, usually I let you guys just do these on your own. It's just vocab, okay? So I'm not going to go through it every time. Working papers today, I want to do the first one with you. So let's have this open up. So the work together is just looking at the transactions that we just had. Please remember that you can always go back into here. You can look at this worksheet. It's going to help you out a ton if you're having trouble. Or at the same time, you can always access the book that's on the far right side. So let's jump in here and take a look at the transactions. And it says put the pluses and minuses just like we did for 1-2. So we received cash from sales. I look at that and I say, all right, I know that that's a revenue. And if I receive cash, my cash is going to go up. And it's a revenue. What affects, or sales and revenue affect what? Well, it affects the owner's equity. So I'm also going to put a plus over here because when the business is doing well, we have an increase in the capital for the owner, right? So next we have sold services on account. Please remember, there's no cash affected here, okay, for transaction number 2. So nothing else should be affected. If it doesn't say cash here, right, cash isn't affected. So we sold services on account to Harman Company. This is still a revenue, just as we just discussed. Still a revenue, but it's a little bit different because now we're going to use accounts receivable. Somebody, Harman Company, owes us money. So it's going to increase here, our accounts receivable. And our capital, our owner's equity and capital, go up as well because we assume that everybody's a wonderful person and they're all going to pay us, okay? So we don't get into assuming people might not pay us until advanced accounting or accounting essentials. In intro to accounting, we're very optimistic. So we have a left side that increase and a right side. For number 3, paid cash for a cell phone bill. Sure does sound like an expense to me. So we look at this, we use our detective skills and we say paid cash. Sounds like cash went down. Now, how do expenses affect our owner's equity and our capital? It brings it down. Okay, because that's a cost of producing or selling our goods or services. So for number 4, we received cash on account from Harman Company. Now this is affecting our cash. So what accounts are going to be affected? Well, I received cash, but now Harman Company is paying us some of the money that they owe us. So remember, accounts receivable, just like accounts payable, is an account that looks at how much somebody else owes us, okay? Accounts payable is how much we owe somebody else. Accounts receivable is how much somebody else owes us as the business. So for this, our account balance is going to go down because they're paying us and they now owe us less. So we have two assets, one goes up, one goes down. Accounting equation is balanced. Number 5, owner withdrew equity in the form of cash. This is a withdrawal. So if they withdrew equity in the form of cash, means that they took cash out of the business. And how does that affect our owner's equity or Nathaniel Conrad's capital here? It brings it down, okay? Because now money has been taken out of the business. It's the exact opposite of when we invest money into the business. So there we go. Let's save and continue here. And this second working paper, the on your own, is the exact same thing. I don't see anything too weird. Paid cash for rent would be an expense. So yeah, I don't see anything too weird here. I'm going to save and continue because I would like you to do that on your own. So you can see I'm just going to show you that I'm done. Let's grade it and show you the first problem we looked at, and we have a 2 out of 2 there. Somehow you still get a 1.3 out of 2 if you don't do anything, I guess, for the on your own. Please do something, no? So there we go. That's the work together. And the application problem, you're also going to do on your own, but I would like to at least show you what it looks like because it's a little bit different than before. It's very similar to 1-2, but there's one extra step. Just wait for it to load here. All right. So once again, we have eight transactions that took place with dollar amounts, and we are calculating out those balances. Now, there's one, so this is the same thing that we did in 1-2, okay? You look at the transaction, is it a plus or is it a minus, the dollar amount, and then you fill in the new balances. Make sure that if the new balance is 0, you put in 0, okay, until there's a number that you carry down. And over here, though, this is the new thing, okay, where you're going to put in either a revenue, expense, investment, or withdrawal. So you're going to label these transactions. So the first transaction was paid cash for rent. Well, that's an expense. We're going to write down expense here. Next, owner withdrew equity in the form of cash for transaction number 2. So for transaction number 2, the owner took out money. What's that called? It's called a withdrawal. Okay. So you're going to use expense, withdrawal, revenue, or investment. Please remember that when we sell services on account, it's still a revenue. All right. And when a company pays cash, when a company pays cash on account, like this number 8, received cash on account, that's not a revenue. Okay. That's nothing. Because why is that? Well, because we've already recorded as a revenue at a previous time and has already affected our capital. So we covered that in the lesson, but just a friendly reminder. So here you're going to label them. Like for number 8, you might not have anything in there. Okay. So I will leave you guys to it. Thank you for listening. If you have any questions, let me know.